Can you trade a combination of two simple indicators on a portfolio of ETFs, beat the index with around 1/3 of the risk, generate this equity curve, and only spend a few minutes per day to do so? My name is David from Critical Trading, and I'm going to answer this question in this video. In today's video, I will test indicator called Williams percent R, see if it works, and then try to combine it with a different indicator to improve the results. The indicator I will combine it with is MACD, and I managed to improve the performance significantly. Watch this video till the end to learn exactly how you can do it too. This is a second part of my indicator testing series. If you haven't seen the first one, have a look at the link to the playlist I've put in the description of this video. And if these videos are something you're interested in, then consider subscribing to my channel and enable notifications by clicking that little bell icon. That way you actually get notified when I publish a new video on this topic. Williams percent R, an indicator I've personally known of for a long time but never actually investigated it. Now, I've mostly traded manually up to now, where I wasn't using any indicators, but recently started pivoting towards systematic trading more and more, and so I'm always on the lookout for new trading techniques and tools that can be systematized, so written in the form of an algorithm. This particular indicator is one of such tools I've come across recently, and so I've naturally been curious to see how it performs. Williams percent R is an oscillator, meaning that it's meant to be used as a timing tool for mean reversion trades, so trades against a shorter term momentum in the markets. I've got this indicator plotted below my chart in the form of a yellow line. Now, I'm not so much into theory myself, but rather focus on the practical side. But put simply, this indicator looks at the current closing price and puts it into the context of previous highest high for a given period. It also takes the lowest low in a given period into the account in order to work out whether the market is overbought or oversold. As a result, we get the indicator readings oscillating in a certain range. Now, I want to test this indicator as a mean reverting timing tool, and so I want to set up my test to buy the market when its readings get below a certain level. The level I will be using is -90. Let me just plot it on the screen. I will use the opposite logic to exit my trades. I will use level -20 as an exit level. The period of the indicator I'll be using is 5 bars. So, to sum up the basic trading setup based on Williams percent R indicator, we've got two buy setups on these 2 bars. Now, this is because the indicator reading is below the bottom red line, -90. The corresponding exit signal gets generated here when the indicator crosses about the -20 line. This means that the trade would have been closed on this bar. Additionally, I'll be using one more rule in my test. I want to ensure that the trades will only be open in a suitable market regime. In this case, as I'm testing a long-only version on a basket of different ETFs, I will include a filter that only takes trades when the market is above the 200-day moving average, which is this turquoise line here. This is a rather standard filter that's widely used in the systematic trading arena, and I use it myself in a number of my systematic strategies. Granted, one could come up with something more complex, but the improvement would be very, very minor in my experience. As far as the markets are concerned, I will conduct this test on a basket of different exchange traded funds, as visible on this list to the left of my screen. These are various ETFs covering US markets, but also some international markets as well. As always, I'm conducting my test on daily time frames, as I only trade those for various reasons. One of such being that swing strategies, so strategies based on daily time frames, are generally easier to develop, implement and run. Intraday trading of automated systems is generally much more difficult and demanding, yet the vast majority of beginners with no experience seem to be going that way right at the start. If you're new to systematic trading, I highly recommend that you start on daily timeframes. Now let's have a look at the initial results of a simple test of Williams percent R indicator on its own. As I said just now, these are the results of trading this indicator on daily timeframes on a basket of various ETFs as seen on my previous screen. This test assumes 50% margin and holds a maximum of 5 positions that are open simultaneously. In case of multiple signals that exceed this maximum, I've written the code to rank these based on the 21-day return of that particular ETF. Obviously, the higher the 21-day return, the higher the rank is. Basic stop loss of ATR 20 multiplied by 2 at the time of entry is used as well. The equity curve certainly looks promising, but is visibly quite volatile. I will go over the actual backtest figures at the end of this video, but we can clearly see area of significant volatility here. Now, this is very common among mean reverting trading strategies or tools. An area like this one where there's a lot of small profits that result in a very smooth equity with a nice upward slope will inevitably be followed by a couple of big losses and high volatility. Nevertheless, equity looked promising, and so I was curious as to whether this could be improved. One thing that stood out to me when looking at the results is that the number of trades was quite high and the average trade size was quite low. I was therefore looking for something to filter out some trades and hoped to obviously filter out those with low potential to increase the average trade size. To do that, I opted for MACD. Now, MACD is a very well-known indicator that needs no introduction at all, and I've come across both its trend following and mean reverting applications before. I've got this tool plotted on the bottom of my screen, consisting of two lines, fast and slow. I'm not really interested in using these though. Instead, I'm going to use the difference between these two lines, which is normally displayed in the form of a histogram. I've now changed my code to plot the difference between these two MACD lines. This difference is plotted as histogram and is smoothed out by simple moving average with period of 5. Now, as you can see, some of the MACD histogram bars are darker and some are lighter. I've written this in my code deliberately. The reason for this is that the way I will use the MACD as an additional filter to complement the Williams %R is that the current MACD histogram value has to be the lowest across its last 5 values. The lighter bars are those at which this criteria is satisfied. So starting from this bar up to this one, the MACD filter criteria is satisfied, meaning that any setups on Williams %R indicator above it are valid. On the other hand, as the MACD histogram starts rising and its values are not among the lowest anymore, bars change color, resulting in any Williams %R buy setups being filtered out. The rationale behind this kind of a filter is that I want to filter out some of the Williams %R signals with a view of filtering out those where the MACD shows too much strength, likely meaning that the market's pullback is not deep enough. Now, let's zoom in and go over an example trade with both indicators combined. Williams %R indicator crossed below the signal line -90 here. That's the first rule. The second rule, however, is the additional MACD histogram filter. Its value at the time of the signal has to be its lowest across its 5 recent values. This rule is true if the bar is in light turquoise color, which it is, and so the signal is valid and is generated as of close of this particular candlestick. Now, onto the sell rule. In the first test I conducted, where I tested just the Williams %R on its own, I've based both entry and exit rule on it. In this test, however, I decided to use the MACD to time the exit with a view of improving the average trade size by holding it a little longer on average. Sell signal gets generated when the MACD histogram rises for the first time after the entry. In other words, when the bar's color shade changes from bright to dark. That took place in this area, where we can see the changing color shade across the two MACD histogram bars. Trade is closed at the candlestick at which the MACD histogram bar gets darker, which in this case corresponds with this particular candlestick. Those were all the revised rules, with the backtest settings and specs being the same as in my initial test. So let's have a look at the equity curves. Equity curves look as follows. The yellow curve relates to the original test I made, whereas the turquoise curve is the result of combination of Williams %R and the MACD histogram. Both are based on the same basket of various ETFs, covering periods starting from 2003 up to now, daily timeframes, trading commissions included. The turquoise line clearly looks much better and smoother, so let's have a look at how it translates into the backtest figures. Backtest report on the right is the original test I conducted, so Williams %R on its own, whereas the report on the left is the Williams %R combined with MACD histogram filter and MACD histogram exit. There's also SPY buy and hold comparison that acts as a benchmark in this case. First of all, the total number of trades has gone down, which is exactly what I was hoping to achieve. At the same time though, the average annual return has gone up, which is an ideal outcome and is driven by the fact that the average size has doubled from 0.31% to 0.62% by using this additional filter. Transaction costs are included as always, but the slippage isn't, which would have been an issue in the original version as the average trade size was only 0.31%. It is less of an issue in the improved version though, and I've actually run a test that accounted for a slippage of 2 ticks per side, where obviously the results slightly worsened, but not significantly by any means. One of the key things that most people fail to recognize and take into the account is the exposure. In layman terms, it means how much of the time is your capital invested in this strategy should you trade it. In case of this indicator combination, we're only talking about 23%, meaning that your capital would have been freed up for the remaining 77% of time. And this is extremely important as you can use your capital trading a different strategy simultaneously and increase the overall efficiency of your capital. If you just bought the SPY, you would have been invested 100% of time and could not use your capital elsewhere. And most importantly, maximum drawdown is only about 1/3 of the buy and hold, but has also improved significantly compared to the original Williams %R indicator on its own. So very promising results indeed. For your own trading, I would recommend that you try testing this on various ETFs as I did, but combine it with different low exposure techniques, such as some of the candlestick patterns I tested as well. As always, I hope that you found this video beneficial and took something out of it to improve your own trading. This is David at Critical Trading, signing out.